Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq 100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Thursday afternoon, we have Joyce, Managing Director on Nasdaq's Market Intelligence Desk, for an update on technical levels to watch in the Nasdaq 100, live from the market site. It's good to be back with you in person, but despite the performance over the past decade and a half with the Nasdaq 100, it's just having an ugly day today. Yeah, it's an ugly day. It's been an ugly year so far, and not all too surprising. We've been talking about growth versus value since December. That ratio peaked back in August of 2020. And then we kind of chopped around for 12, 13 months up until we retested that high last November. We actually made a slightly higher high and then quickly rolled over. So really since November, early December, that relative performance has been changing and growth has been underperforming. So certainly this dramatic of a pullback, and this violent price action that we're seeing in certain industries and certain stocks, that certainly is surprising. But given kind of what is going on with the macroeconomic backdrop, the geopolitics, China shutting down again, all of that is surprising. Yeah, I mean, it seems as if there's only so many tools in the Fed's toolbox, and raising rates is one thing, but virtually everything else is out of their control. So, and at the end of the day, regardless of your opinion of the Fed and how it's being managed, I mean, the delicate balancing act that they have to keep the economy not too hot, not too cold, is not an easy thing. And when you have forces beyond your control, a pandemic, supply chain constraints, Russia, China, this could be a little bit longer term, perhaps. Yeah, I mean, so the Fed is obviously, the members of the Fed, they're obviously very smart, but, what are they looking at, or what were they looking at last year? The Central Bank of Brazil began raising rates in March of 21. We started raising rates in March of 22, and only in November did we drop the term transitory, when, even I was even noticing that inflation was becoming a big problem well before that. And now we're going to do the opposite. So it seems like the Fed and the markets are now in this kind of boom bust kind of cycle where we'd much rather prefer steadier kind of activity, steadier kind of growth. There's a tremendous amount of fiscal stimulus that was put on the markets, and then the monetary policy was very easy for probably longer than it should have been. So right. Well, I mean, do we really need to move rates as low as they were even before the pandemic, right? When the economy was doing well, I mean, we had some of the best numbers that we've seen. Perhaps we were just moving too low for not necessarily the best reasons. But let's take a look at the numbers, because the numbers don't lie. Your first chart, Nasdaq 100, what levels are you looking at? Well, so last week we highlighted the 13,000 level. That was a prior low during this downtrend. We bounced off of it, and then just last week on Thursday we were retesting that low, and then Friday we broke down below it. So that was the prior support we were looking at. Now I think we're looking at the 12 to 12,200 area as the next support from here. If we can't rebound, either late tomorrow into Monday, I think 12,000 and 12,200, which is a prior pivot from late last year. That would be the level that I would be looking at. Down below there, when you have pretty significant sell-offs, like we saw in, like, say, 2018, 2016, the 200-week average is a popular level to look at, and that's below 11,000. So that's a good ways down from here still. So but near term, 12,000, 12,200. It's just so hard to conceptualize because we move so far and so fast in such a short period of time, not just on the Nasdaq 100, but I mean the S&P 500 as well. Let's take a look at the 10-year chart, because I mean, really, the bond market appears to have known something maybe perhaps the equity market did. Yeah, so the bond market, and this is what really has caught me off guard. I was expecting in mid-March that the risk-off moves would eventually translate into the safe haven treasuries catching a bid, and they obviously have not. April was one of the worst months in at least decades. I heard Jim Bianco talking about it being the worst month since the late 1700s for the aggregate bond index. So we're seeing some extreme price action there. If you can see on the weekly period chart, so this is actually a monthly period chart. Last week we highlighted the quarterly period chart, which showed going back to 1980 that this quarter we're breaking up above a pretty a clearly significant, clearly defined downtrend line, and we're now continuing higher. If we zoom in a little bit on that, we go monthly, we could see the 3 to 315 level, that range on the yield
has been resistance going back to 2012. We've tested it twice. This is now the third test since 2012. So the weekly RSI is up at 76. It's the highest since 1980. That's the RSI on the yield. So, it's certainly at the overbought condition right here, but there's two ways to read that. Is it overbought and due for a big pullback, or is it overbought, which is telling us we're undergoing a major structural change and higher rates is something that's going to be here longer lasting?
Well, it's interesting. You see the yields moving higher, so you know what that means, that there's not the money going into bonds. It's not going into equities. It makes you wonder at some point, when is money going to come back into the market with valuations being obviously more attractive than they were, yesterday? Managers don't get paid to sit in cash, so it makes you wonder when you're going to start to see some of that come back into the market.
Yeah, they don't get paid to sit in cash. They also don't get paid to lose a lot of money
right.
as well. The multiples have certainly come in. I would absolutely agree with that. I think we peaked around 22, 23, and now we're down around the 18 on the PE for the S&P 500, the forward PE, looking at 12 months. So multiples have certainly come in. Now the question is from here, what are earnings going to do? Are earnings now going to come in? Will that be the cause of the next leg down, or is there some other catalyst? I think a lot will depend on what China does in its response to COVID. Is it going to continue to lock down? Will the lockdowns get worse? And then, how long is the Fed and how aggressive is the Fed going to get? The Fed doesn't have much control on the supply side, but they can control or impact the demand side. So, they can continue raising rates, and it looks like right now they're on autopilot, quote unquote, their famous quote from 2018 by Powell. But now it looks like they're on autopilot for 50 rate hikes, at least for the next 2 or so meetings. So we'll see if they can stick with that.
All right, Brian, appreciate the insight as always. Thanks for
you.
joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.